Aloha, and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. Welcome to episode number 13, lucky number 13. Exit strategy is a growth strategy. And if you're waiting to get to the edge of exit before you start to prepare, you're giving away money. You're leaving money on the table. What you really want to take a look at is preparation 5, 4, 3, 2 years in advance so that you're getting the maximum multiple. And it's not a last minute event. You are planning through strategic innovation, strategic growth, strategic framework. The key word today is strategy. So are you building a company you can run or a company that somebody else can buy? Another way to take a look at this or to explain it is a blueprint with certainty. A blueprint with certainty. Because at the end of the day, when you go to sell, what you want to have happen is you want to have the ability to hand over the keys to the private equity firm, the buyer, the person, the investor who's coming in and saying, hey, it's all yours with minimal effort. That is the dream. That's an A+ sell. Plus, when you get paid the maximum multiple. And when you're taking a look at a buyer design focus, this is what it is. You're preparing that company for you to hand over the keys, walk away. And another way to say this is transferability with risk reduction. There's always some sort of risk in a purchase, but the more that you can proof that the company is the type of company that somebody wants to buy, the practice is the type of practice that somebody wants to buy. You can decide, you have optionality. You can decide whether to sell or not. Sometimes what will happen is someone will go down this path and say, hey, I want to prepare to sell in 5 years. Okay, cool. And then they get 3 years into the 5-year plan and they're like, hey, this thing's pretty much running on its own. I can step away for a couple months at a time. I can be away from the office and things are good. I've got other people to step in. It is the optionality that you're taking a look for. Now, one of the ways that you can do this and define the core thesis is to think of what would stop. We're going to use some inversion thinking right here. We're going to use some mental models. What would stop somebody from purchasing your company, your practice, your office, whatever product you have to sell? Okay. It could be that you don't have standard operating procedures. Okay. Well, then that means that you need standard operating procedures. It could be that you're not tracking KPIs to the level that you should. It could mean not profitability. But I would take a look and say, hey, okay, what are the things that would slow the ability for me to close this deal? And what do I need to fix? I will share with you from doing enough of this, it's usually the books. It's usually having a clean set of books. And that is probably one of the best places to start besides SOPs and KPIs, standard operating procedures, and key performance indicators. There's a couple of other ones on this list, like having a standardized sales process, having a marketing flywheel. Those are the five buckets that I would say, hey, what are the opportunities? Because at the end of the day, buyers, they underwrite risk first. They're like, hey, what's wrong with this company? So you might as well start with, hey, what's wrong with this company? What could we fix? And then they look at upside second. I love to tell this story that, inside of most firms, whether it's private equity, family office, private investor, there's somebody who went to a business school, and they probably went to a pretty good business school. And I like to call him Excel Eddie. And Excel Eddie is the best at Excel files. And Excel Eddie can drop in any amount of information in and spits out data. And the data is going to be ratios. The data is going to be quick acid tests. The data is going to be, this is how much we're willing to pay for the company. And the more risk that you can remove and the more blueprint and certainty you have, the higher you can negotiate and say, hey, I want more money. I'm not just your average Joe company. I'm not just the regular company. So starting here on out, you should be asking 2 questions. Does it reduce risk or does it add risk? So somebody comes to you and says, hey, boss, hey, chief, I really want to do this thing. And then the question is, does it reduce risk or does it add risk? And you can have the conversation in your head. You could have the conversation with your team. You could have the conversation with a chief counsel that you have. But whatever happens, those are the two questions. Does it reduce risk or does it add risk? And if you're playing from this playbook, then you're miles ahead of pretty much anybody else who's not having some sort of game plan. There's three items that could be on the test. Is it repeatable? Is it transferable? And is it measurable? Repeatable, transferable, measurable. And if it fails any of those, it should be a red flag. Hey, timeout, can't do it. And if you really wanted to, you could do a scoring matrix. You could do 1 to 10 on repeatable, 1 to 10 on transferable, 1 to 10 on measurable, and then out of 30, where's it at? And if it's not like at 25, go back to the drawing board. If it's not at 20, hey, it needs some more work. If it's a 10 or a 15, it's a no. It's not going to happen. And you can build out a matrix and put some definitions in, and this would take you all of 20 minutes. 20 minutes. That you could go to your team and say, hey, from here on out, before we make any move or any initiative, it's got to be repeatable, it's got to be transferable, and it's got to be measurable. And here's how you're going to score. 0 to 3 is this, 4 to 7 is this, 7 to 10 is this explanation. And then you're going to say, there's no way that we're going to do anything unless it scores above random number 25. Your answer is going to be different than mine. I can't give you every piece of information, but one of the best pieces of advice that I ever got from one of my mentors, he was like, Scott, just when you come to me with an idea, make sure that it's strategic. Give me a 1-page thesis, share with me what it is, give me the upside, give me the downside, and tell me what you think it's going to do. And you can initiate something like that. It doesn't have to be the way that I said it with a 3-process framework, but you do want to have something. Because at the end of the day, what ends up happening is there's common traps. And one of those common traps is owner dependency. Owner dependency is, hey, everything's got to run through the boss. It could be client concentration, right? So if I have one client and I'm doing $1 million a year in revenue, my client concentration is 1, that's a problem. And so the general rule is this. If you have a client that is more than 20 or 30% of your business, of your revenue, that is a sign that, hey, maybe it's time to get some other people. An old strategy that was used in the 90s was to go in, help companies grow, negotiate down their price, become the only vendor, only to come back and say, now we need to go negotiate down the price. And so what would happen is these companies would become dependent on the one person who was there to help them, and then absolutely crush them on pricing, and then come back. And that that client dependency created a lot of problems and ended up costing a lot of companies problems and issues. I want to give you some of the most common traps that it comes down to when you're looking to sell your business and you're getting dinged and dented on your valuation. And one of them is owner dependency. It means everything's got to work through you. There's no chief executive officer that could do the work. There's no manager. There's no ops. Everything goes through you, which means you can't walk away from the business. Which means when you go to sell, they're going to say, hey, here's what we need. We need you to stick around for 6 months. Now, I've seen enough exits. And here's what happens. Week 1, hey, I'm kind of free. Week 2, hey, they're making some changes around here. Week 3, I could be on the beach. Week 4, I want to be on the beach. And then there's some resentment that goes into, well, I sold the company, but now I got to stick around for 5 more months or for a year. And it's better to take care of that dependency now. Client concentration. Client concentration is, if I have one client, one person paying me, my client concentration is 0. Somebody leaves, I'm at 100% loss. If I got two clients and one person leaves, I'm at a 50% loss. The number to shoot for is less than 20. Some people will tell you less than 30, but I really want you to have your maximum multiple. It's less than 20. And this is a common report, right? You got Excel Eddie that's going to go to town and have some fun and create a report and take a look at what your business is doing. Custom work sprawl is the next thing. There's so many custom jobs that need to be done. So anything that's custom has no real framework. It's going to have loose framework, but it's also going to mean it's going to be tough to figure out what the investment is. It's going to be tough to figure out about profitability. custom comes with a lot of problems, whether it's a website, whether it is a building, whether it is a car. Like, you start thinking in terms of it's custom, there's only certain people that can work on it. And then they take a look and like, I don't want to pick up somebody else's work. So if everything that you're doing is custom, it's time to start thinking, okay, how do we build a blueprint? Like, this is what we do. This is how we work. This is the framework. This is the strategy. And then last on this list is undisciplined hiring. I cannot remember who told me this. It wasn't me. Okay, so this is not my framework. It is somebody else's. No description, no position. Like, if the job doesn't have a description, you shouldn't be hiring for it, because you can't build out, hey, here's what your expectations are. Here's what you're going to be expected to do. Here is what we want from you. Here is how we define success. You're not going to be able to do it. You're going to have somebody who's working 15, 20 hours a week and you're paying them for 40. Or I've seen this, that there was an employee inside of an organization that nobody knew was on the books for 2 years because they just kind of disappeared, and they were getting paid paycheck after paycheck because nobody told HR. And so this person was traveling. They were getting money drafted every month into their account because they didn't have anybody to answer to. They were onboarded. The people were like, yeah, on board. And then one transfer of a management went to another, and then one of the managers left. And so it kind of put this person in limbo. They just stopped showing up, and they kept getting paid. They had a company phone. They had a company laptop. They had, the only thing they didn't have was a company credit card. But short of that, they were getting paid to travel, and there was no way to prove where they were. And then somebody was like, hey, who is this person that's getting a check? Who do they answer to? Comes out, hey, we don't even know. It's been 2 years since they've been on the books. We don't even know who this person is. And message from your sponsor, Scott Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. To be an exit-minded operator, you're working on a 5-year, 4-year, 3-year runway, not a 90-day sprint. The longer that you have for your horizon, the more optionality you have, the better off that you're going to be. You can hire teams. You can actually take a loss and still be okay. Like, something goes sideways and you're able to recover over a quarter or two and you're still good. The shorter your time horizon, the shorter that event is, the bigger problem, the more risk you have. What you're really searching for is predictability. Predictability is always the magic word when it comes to selling your business. And it's exactly what multiplies the value. So here's what you could do, is you can build a calendar of initiatives. And the way that it works is, if you're going to break it down into the quarter, you have 4 initiatives per year that you can run. And if you have 3 years till you sell, that's 12 initiatives. Now, not all of them are going to be fruitful. So let's say there's 9. You have to pick and say, which ones are we going to take? Now, think about this. If you're on a 5-year horizon, that means you've got 15 initiatives that you can run if they're based upon the quarter. And if they're done faster, you might be able to overlap some of them. But if you're thinking strategically, it's like, okay, well, I got to work in some 90-day sprints. So how do we put in leadership? How do we put in standard operating procedures? How do we put in cadence? How do we put in KPIs? And those were not put in order. Like, I'm giving you random examples. But if you start thinking in terms of, hey, I've got a time horizon, and each quarter is like one segment that I have, and if I'm 3 years out, I've got 12 plays in the playbook that I can run. Now, you might have a big enough team that they can run each division, each department can run a playbook, but an overall overarching goal for the organization, for the company, if it's only capable of running one, it's one playbook or one process per quarter that you can work with it. And if you can get it done faster, that's fine too. You want some capital efficiency as a valuation leverage. Because if you can prove, like, hey, these numbers are consistent, these numbers are predictable, You want to be able to show proportional increases over time and have a history. And exit strategy really forces you to ask, is this scalable growth or expensive growth? Is it a repeatable acquisition or is it a one-off situation? If it's a one-off situation, it shouldn't happen very often. And it should be very profitable. But then it comes down to, like, if it's one-off, it means it's probably going to be custom work. We're going to go back. Like, how much custom work can you achieve? How much can you do? When investors come in, they want a leadership machine, not a founder machine. So it means clear roles, decision rights, accountability. Performance can't depend upon one person. The maps decide who's in charge. And, the delegation happens, and what ends up being the fruit of all this labor is you are able to walk away. You are able to hand over the keys. You're able to take the books. Like this should be the exit that you dream of. You know that you're going to sell on a Monday. The business is going to transfer on a Monday. And on that weekend, 2-3 days before, a moving company comes in and takes all the stuff that you want. That you have your meeting, you introduce the team to the new owners, to the new PE firm, to the new investors, and you're like, hey guys, really appreciate the work, really appreciate everything you did. I'm off to the races. Have a good life. Thanks for everything you did. That's not how you're going to say it, right? I'm giving you the truncated version. But if you can do that, you can just know that on a Monday, it's going to happen typically around 7:30 to 8. By 9 o'clock, you can get in your car and say, okay, I'm free and clear for the most part. I mean, you're going to have descriptions and duties that are probably needed for 90 days. But for the most part, you can go home and say, I'm out. I'm done. Finito. Or as they say in Hawaii, all pow. People want to shoot for expansion, and it's good when it doesn't have the dependence, and it increases the durability of the company, the process, the programs, the practice. If it increases complexity, if it increases like, hey, I'm out of control, then it's a problem. Like if you're going to expand into a new territory, it should really be thought out if you're going to make a sale. If you're going to exit, like, is it creating risk? Like, does it increase my risk profile? Because you want confidence from clean data. You want consistent performance. You want transparent controls. You're building exit evidence. You're building proof for the buyer that, hey, there's consistency over and over and over again. And what you can do is you can build a report. Like how ready are we to get the maximum multiple? How ready are we to get paid so that, like, we could be you and your significant other? We could be you as an individual, but are you ready to exit and are you ready to get out? Individually, if you can't tell anybody on your team that you're preparing to exit, you can create a scorecard behind the scenes and say, where are we at? What's going to break this deal? Almost every time it's going to be accounting. It's going to be KPIs. It's going to be scorecards. It's going to be a sales process, or it's going to be a marketing machine. There's like those 5 buckets that everything's going to fall back into, and you really got to know that. So what's the one metric that's going to cost you the most? You're going to create a diagnostic scoring process to figure out, like, hey, which one do we tackle first? Which one do I put a team on? And here's the thing. You might have to bring out outside fractional help. You might have to bring somebody on board just for a short term and say, hey, you're going to help me get this up and running. It could be a consultant. It could be a fractional CFO. It could be a fractional sales trainer. It could be a fractional marketing team. Like, you have a million different options. So if you're like, hey, what's the thing that I need to fix the most that's going to scare a buyer away? Like, really fill in that blank. Exit strategy, it's not about selling. It's about building a business that's worth a premium buyer to get the maximum multiple. So this week, figure out the one thing that you really need to work on and the one thing that you need to achieve that's going to give you the freedom that you're looking for, or the ability to move and do whatever you want. Mahalo for listening to the Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.